Hey there, Mark Lewis here from Mark's Money Secrets. Everybody's talking about John D. Rockefeller's waterfall method, the magic bullet somehow for generational wealth. Now, I'm not going to knock John D. Rockefeller. The dude knew what he was talking about, knew what he was doing, knew how to manipulate society for his benefit, and ended up being the richest man to ever live, really. But we need to kind of break down this so-called waterfall method, which is a combination of trust and insurance, life insurance. And everybody thinks that it's really about trust, but the trust is the smallest part of how this whole thing works. And we want to break it down so that we understand fully, is this something that we want to do? Is it something we want to avoid? Or is it something we want to tack on to our corporate structure for added benefit? Let's roll. So what is the waterfall method? It's sort of a weird misnamed thing that JDR, John D. Rockefeller, came up with decades and decades ago. A way to create generational wealth using a irrevocable non-grantor trust and some kind of whole life or IUL. Now, I'm sure he didn't have IULs back then, but he certainly had some version of whole life. See, a whole life policy gives you a couple of really, really cool things that no other term life policy can. And I would argue that what he did had much, much less to do with trusts than it does with whole life policies. And in fact, you could replace the trust in this case with a multi-member LLC and do the same idea. But let's stick with exactly what he did. And that is simply, he put a irrevocable non-grantor trust at the top of this structure. Should we be doing business in such a thing? No. The purpose of a trust is to hold assets, and he knew that. He did Standard Oil in his corporate structure, but he's doing his generational wealth building on the trust and insurance side. Beneath that, he funded himself personally a whole life policy, let's say, for his wife. And that whole life policy, let's say, got $100,000. And then from that $100,000, he was able to get a $500,000 tax-free death benefit. While the money's sitting in that whole life policy, it's making, let's say, 6% tax-free. That's, $6,000 a year. And after 40 years, well, that's $500,000 right there. Well, after 40 years, that's another $250,000 right there. But it has another special benefit. That is, you can withdraw on a loan up to 90% of the value that you've put into that policy. So if it's $100,000, you can take out $90,000 after a few months or so. And now the money that's in there is still making interest for you. Not a lot, maybe 1% or 1.5%, maybe 2%. But the money that you have, you now can get back out 90% of it and use it any old way you wish. That makes the cost of setting up that IUL or that whole life policy 9 times less than if you had to leave it in there. Now, again, there's value for leaving it in there at 6 or 7% or so, tax-free. That's fine. But if you needed to reinvest it in business, as he did, you can do this all day long. Then, if you die, they just take that out of the $500,000 death benefit, and what's left goes to the beneficiaries. Who's the beneficiaries? The trust. A lot of people make this mistake. Having people be the beneficiary, huge mistake. Put it into your trust or corporate structure for certain. In this case, when he died, the $500,000 went into the trust. Now there's $500,000 in a trust that's maybe sitting, I'm making it up, let's say in a 5% sweep account. Now that $500,000 is making $25,000 every year. Not bad. Then let's say his wife has a child, and they set up a whole life policy for that. Where does that money come from? The trust. The trust sets up a whole life policy and pays for it. And then that person is able to take out 90% loan to value from the cash value that the trust put into that whole life policy for them to do whatever they wish. When they die, who's the beneficiary? The trust. The money goes back to the trust plus the death benefit. It's pretty great. And on and on and on it goes until after a couple of generations, that trust is worth tens, if not hundreds of millions of dollars, and it got it all tax-free. Now, an irrevocable non-grantor trust is the second worst taxation in the code, so whatever we put in there, we definitely want to be tax-free. Otherwise, it's no bueno. But this then creates wealth that if you wanted to, that trust could create sort of a drip or some kind of ongoing distributions that could help capitalize the corporate structure in a way that everybody gets to benefit as long as the principal isn't reduced. Every time there's a new child or a new marriage, that person's set up with their own whole life policy, with the beneficiaries being the trust. What a great way to set up generational wealth. Now, again, I said you can replace that trust at the top with an LLC, which might actually bring better results, because if that LLC were somehow connected to another corporate structure and it was multi-member, which it naturally would be, all of the death benefits that are going into that LLC create basis for anybody who's a member who had the life insurance policy. And now any profits that are coming to members can go to them tax-free from the return of basis. We call it a capital distribution. We talk about this all the time. Either way, you're winning, trust or LLC. And the waterfall method, again, don't do business in this structure. This is for holding and building generational wealth, not for doing business. So as you can see, it's not for everyone, and you need to have no small amount of capital available to you if you're going to start this up, but it is a wonderful way to create generational ongoing wealth. It's a terrible way, as you can see, to build business. This is not how we build business. We want to always be sure to separate business from estate planning or from legacy preservation. They really don't go together. And that's one of the reasons why IRAs and 401ks are terrible vehicles for setting up generational wealth, especially after the so-called Secure Act that happened earlier this year, where it kind of removed any value that they might have for generational wealth. And similarly, life insurance policies aren't great for retirement either, but they are good for doing business, in my humble opinion, and for building profits because of their ability to make your money work doubly as hard for you. Hopefully, this has been valuable for you. If so, please subscribe here on the channel. And we walk folks through the entire process of doing a corporate structure, not a waterfall method. I'm not an insurance agent, and none of us are either. But for the corporate structure, for building the profit side, we have a mastermind where we walk folks for 10 weeks through an intensive so that on the other end, they have everything they need to be able to create additional structures and build for themselves and scale. We go through bylaws, minutes, operating agreements, contracts, taxes, compliance, structures, all of it, so that at the end they know how to do that. If you want to participate in our next mastermind, 10 weeks with us, hanging out with us in a group, reach out. And if you're a DIY, kind of do-it-yourselfer, there's tons and tons of classes available. You can see the link in the description for that. And if we don't see you there, hopefully on one of our Instagram lives that we do just about every day. If not, be wealthy.